All right, let's dive into our explainer today. We're looking at a huge player in the Scandinavian financial world, the insurance company Tryg. And we're going to see if it really lives up to its name, which, fun fact, literally means safe or secure in Danish. So, if you're an investor, I'm willing to bet this is the question that's on your mind right now. With markets going all over the place, where on earth do you put your money to find some stability, some real quality, and hopefully some reliable returns? Well, the analysis we're digging into today points us towards one potential answer, and that's Tryg. It's the biggest non-life insurer in the entire Nordic region, and we're about to break down exactly why it might just be that high-quality company you're looking for. The central theme running through this whole analysis, and I think it's a great way to picture it, is to think of Tryg as a financial fortress. And that's not just a catchy tagline. It's an investment thesis that's built on some really powerful, really solid pillars. So what are the walls of this fortress built from? Well, first, you've got a dominant market position. Then you add in profitability that's just way better than its competitors. They've got a clear, actionable plan for growth, a serious commitment to paying back shareholders, and it's all standing on a rock-solid fortress of a balance sheet. Okay, so how does this fortress actually generate its wealth? It really all boils down to its core business, what we can call its underwriting profit machine. If you can get your head around this, you'll understand the entire investment case. And to measure that machine's efficiency, there's one metric you absolutely have to know: the combined ratio. Look, put simply, it's just their costs, so claims and expenses, divided by the money they bring in from premiums. Anything under 100% means they're making a profit on their actual insurance business. The lower that number, the better. Now, here's where it gets really, really interesting. Look how Tryg stacks up against the competition. At 81%, they're not just profitable, they are leagues ahead of their main rivals. And this isn't a small difference. We're talking about a massive competitive advantage here. Let's make that 81% number really tangible. What does it actually mean? It means for every single dollar in premiums that Tryg collects, they make 19 cents in pure underwriting profit. And that's before they even make a penny from investing that money. It's just an incredibly efficient operation. And here's why this matters so much. This isn't some lucky one-off result. No, it's a structural advantage baked into the business. It comes from being super lean with a crazy low expense ratio and being incredibly disciplined about what risks they're willing to take on. This is the engine that powers the whole fortress. But, a great fortress can't just sit there and defend. It also needs a plan to expand its territory. So let's switch gears and look at Tryg's strategy for growth and see if it's actually credible. And if you want proof that this management team can actually execute, you don't have to look far. That 2021 acquisition of RSA's Nordic business was a massive, complex deal, and by all accounts, they absolutely knocked it out of the park. The proof is in the pudding, right? They delivered nearly 1 billion Danish kroner in synergies from that deal. And get this, they did it ahead of schedule. As an investor, that kind of track record builds a massive amount of confidence. So building on that success, here's their new playbook for 2027. And it's not some vague corporate speak. It's a detailed roadmap aiming for another 1 billion kroner in profit improvements, all broken down into specific goals like better underwriting, more commercial growth, and smarter IT. Okay, so we've got a super profitable, well-run, growing business. But what does all that mean for you, the shareholder? Well, it means this is a management team that is laser-focused on rewarding the owners of the company. This right here comes straight from the horse's mouth. It's their official policy, and it couldn't be clearer. The stated ambition is to grow the dividend they pay out to shareholders every single year. That's a powerful commitment. And look, talk is cheap, right? But these guys walk the talk. The numbers right here show consistent, real, year-over-year growth in that dividend per share. And it doesn't stop there. On top of that growing dividend, when they've got extra cash, they give it back by buying up their own stock. A massive 2 billion kroner program was just announced, which reduces the share count and makes your slice of the pie even more valuable. And the really crucial point here is that these payouts are sustainable. They are supported by that fortress balance sheet we talked about. Their solvency ratio is a formidable 196%. That's way, way above what regulators require. This company isn't stretching to pay shareholders. It's paying from a position of incredible strength.
Now, no investment case is ever complete without playing devil's advocate. You gotta look at the other side of the coin. So let's turn to the potential risks and, of course, the all-important question of valuation. Is it a good deal?
So here's the whole debate in a nutshell. The bulls see a dominant market leader that's incredibly profitable and run by a team that knows what it's doing. The bears, though, they're waving a few caution flags. They point to fierce competition, the rising costs from weather events, and the big one that you have to pay a premium price for all this quality.
That last point is probably the biggest hurdle for investors. Is the stock just plain too expensive compared to its peers? Well, let's not guess. Let's put that to the test and actually look at the numbers. What is so fascinating about this slide is that when you put the price tag right next to the actual performance, a completely different story emerges. Tryg's PE ratio, its price, is actually in line with or even lower than its competitors, yet its performance, that combined ratio, is just so much better. You're getting way more profitability for your money. So the final verdict from the source material is this. Yes, you are paying a premium price for Tryg, but it's a premium that seems totally justified. You're paying for higher quality, you're paying for superior profitability, and you're paying for a business with a much, much lower risk profile.
And that really leaves us with the final question, the one that you, as an investor, have to answer for yourself. In today's uncertain market, does it make sense to pay up for proven quality? Is buying a defensive, profitable, shareholder-friendly fortress like Tryg the smartest move for the long term? That's the core question this analysis leaves us with.